So, welcome to the Accountant's Guide to Protection Planning for mainly for business owners and property investors. Now, the reason why we're running this webinar today, partly, is because there was a study carried out in 2025 by the FCA, which reported that there was a huge protection gap, meaning that nearly 60% of UK adults don't have any basic financial safety, like any life insurance, critical illness cover, or income protection. When we've looked at that, we clearly see, when we're in a fortunate position, that we come across clients looking to obtain a mortgage, and we make those recommendations. But if clients haven't had a mortgage and haven't been with a mortgage advisor firm that offers advice, then there's very few instances that they'll actually have the opportunity to get that advice. However, self-employed people with property generally have an accountant. So understanding a little bit more about the options available to those clients and signposting is a great understanding that what the products are out there we feel is very important. So that's why we're running this for our accountants today. Just give you a bit of an insight of what's available for your clients. I'd like to introduce Kerri. So Kerri is our resident expert in all things protection, and she's going to run through just the webinar today and give some detail. We'll have questions at the end if you don't mind. So any questions, you can pop them in the chat, because if you're anything like me, you'll forget the question at the end. So you can put the question in the chat, and Claudia will be monitoring the chat, and she will be able to point out the questions for Kerri to answer at the end. We do have the third session in our webinar, which is commercial and specialist finance. So that's on the 18th of June in our webinar series. So if you would like to register for that, then there's the QR code, but we'll also send out the slides, and you'll receive an invite to that later on as well. Okay, so as I said, just any questions, put them in the chat, and Kerri will answer at the end. And over to Kerri.
Thank you. So good afternoon, everybody. As Michael said, we're just going to go through a few of the conversation examples that we have with clients and their accountants on a regular basis, that we've found that's where the gap, sometimes can be. As Michael said, there's that big protection gap in the market. Just having a look at a couple of statistics myself. In the self-employment sector, 57% of all self-employed businesses fall under sole traders. So a lot of those people working for themselves, by themselves, no one else around them, solely relying on themselves. So again, a big area where there is a protection gap that hopefully we can explore. So through conversations, in my experience of speaking to a lot of clients, the reason the majority of them don't tend to have any protection is firstly just the understanding of it. If they don't know what it is and they don't know why they need it, they kind of avoid it. But as soon as the understanding is there and the gap is realised through advice, because they've never had any advice either, they do find that need and find that purpose for the insurance through the conversations that we have. Many business owners don't explore the financial risks that sit within the business. They might think about the personal side, but not the business side of things. So again, bringing that sole trader statistic there, being the only person within that business, they're their own risk. So once you sort of explore that area, they realise that there's a big need to protect that. Some people do feel that personal insurance is enough, forgetting that, there are business needs, potentially people within the business they need to insure, or other assets within the business. And just people don't sort of know the impact of losing somebody within the business, whether it is partnership or a key person. And landlords as well, they forget to see their property portfolio as a business, something they've built up as their income as a professional landlord. So these are the kind of areas that we discuss quite often, and why people do think that there's a bit of a miss there. So The 4 areas we generally discuss when looking at people's protection is, what are they trying to protect? So income is up there as the top sort of area. Without income, everything else can be hard to do. So we've been told by providers over the years, based on research that they've done, that every household on average has between 19 and 24 days away from the breadline when they've got no income coming in. So we're going to look at income-based protection here. Business, again, you know, a lot of the clients that we speak to that are self-employed, they're either the main source of income from their family, or they are the only business person within the business. So protecting that business and their income is key. From a personal aspect, to protect your family, everybody wants to look at protecting their home, protecting their family. And property, you know, building up property portfolios is expensive, it's hard work. So looking at protecting that is important as well. And another statistic I just wanted to throw in there, as we all love numbers. From an illness perspective, whether that's short-term or long-term, 1 in 2 of us is predicted to be diagnosed with some form of cancer in our lifetime, and 1 in 3 will suffer with a serious condition like heart attack, stroke, or dementia. So when you sort of think about those figures, it's quite high numbers, and you know, this is where protection can protect those areas, those numbers, those likely statistics of happening. So going to go into some areas of importance. These are questions that we generally do tend to ask clients and the answers we get back. So initially, a lot of people say to us that, you know, keeping their family in the home that they've bought and living is so important to them. Without that home, without that house, without your income, you know, that's something a lot of people worry about is going to get lost from under them. So the big one for a lot of clients is keeping their family in their home if they do pass away or become seriously ill. If you've got an estate that is heavily leveraged against mortgages or debt, people do like to think about the options of leaving that mortgage free, debt free, nothing for the family to have to worry about financially, just inheriting those properties or the estate without any complication. Business protection. A big one for us is businesses that rely on 1 or 2 key people. It may be yourself, it may be somebody else within the business, but protecting what happens if that person isn't around, whether it's temporarily or long term. Can that business rely without that person bringing in profit or their skills or their knowledge to the rest of the team? And helping shareholders protect their share for each other and each other's family, and each other's spouses if they were to pass away. How does that share, where does that share go? And income, again, as I said before, income is everything. You know, without income, we can't really do anything else. So keeping income coming into the family is a big priority to a lot of clients as well. So going to go into a couple of business product types of insurance that we discuss now. There's a lot more available, but we think that the 3 that we're going to discuss are quite key areas within self-employment and sort of small businesses. So the first product that I discuss quite often with self-employed, and a lot of accountants recommend their clients speak to a financial advisor about, is a policy called Relevant Life. It's a tax efficient life insurance policy. So it forms under the same umbrella as life insurance, as a lot of people know, or term assurance. And it does pay out if the policyholder was to pass away or have 12 months or less of a terminal illness diagnosis. But the difference with it being a relevant life policy is it's unique to directors, limited company directors, employees within small businesses, and it's owned by the business, paid for by the business, but it ensures the person that's taking the policy. and it's intended for their beneficiaries. So husband, wife, partner, children. So the business never sees the money. It still goes to the intended beneficiaries. But the key element here for self-employed or limited company directors is that they can offset that as a business expense. So not to take away from their personal budgets, personal allowances. It leaves that money within their own bank accounts. They can have the policy under the business. It's transferable. So if they were to close a limited company, open up a new limited company, they can transfer that policy. If they completely stop, you know, they retire, limited company closes, ceases trading, they can convert that policy into a personal policy to keep that life insurance in place. But it's a really unique product for anyone that is self-employed. Kind of think of it as like a small company's death in service package. So a lot of corporate companies offer that to employees, like 4 times salary, 5 times salary. But this way is something that small businesses can have for themselves or offer to their employees as, you know, a good employee retention policy and things. But like I say, the key element here is that it can be offset. So it's a good tax efficient policy that we can offer that still does what you need it to do from a life insurance perspective. So that's one of our commonly discussed products. And then one that we wanted to highlight today is key person cover, because there's a lot of businesses out there that have a key person within that business, somebody whose role is to, you know, have all those relationships with suppliers or clients. They have the skills, they're leaders within the business, they've got the knowledge, potentially more knowledge than the business owner. You know, they keep everything running, keep that profit coming in, keep that business operational to its, you know, highest levels. If that person disappeared, what happens to the business? You know, what happens to that income? Key person cover, we can offer this to cover what that key person brings into the business. So is it a case of, you know, 5 times their salary or 5 times the annual profits their role brings into the company? If that person was to unfortunately pass away, the business would be able to claim on the policy. It pays the business to use to either cover loss of revenue temporarily, you know, stop that pressure on any immediate cash flow being missing, to keep the confidence with the suppliers and lenders and clients that you've already got whilst you replace that person. You know, replace that person with somebody who's going to be able to take the role over, potentially just as well, but maybe not in the long term. You know, they might need training. You might even need 2 people, because one person that's been in a company for a long time, who's classed as a key person, may do 2 or 3 roles. How easy is it to replace that person instantly? You know, you need money to cover all those costs in the meantime. You need money to cover recruitment costs, you know, searching for the right candidate. So key person cover is really, really good for those small businesses that do rely on 1 or 2 key people. And if they were to pass away, it would be you know, a big loss, not just financially, but in every aspect. Now we've got shareholder protection, which is for shareholders. Anybody who has a business where there is a partnership and split shares. But I'm going to talk about this product based on two shareholders within the business. So a couple of scenarios that we're going to bring up about this product in a moment. But one question I'd like you to think about is, you've got some clients, you've got some self-employed businesses that are shareholders. You've got 2 people, own 50-50 share each. Would your clients that you're thinking of right now want to run the business with their business partner's family if they were to pass away? So from the question, when we ask that, the majority, or 99.9% of the time, the answer is no. Okay, so 2 scenarios here. You've got families that run businesses together, or you've got friends that run businesses together. It works very well. But if one of those partners was to pass away, the surviving partner doesn't always necessarily want to run the business with the family of the person that's passed away, and the family also don't necessarily want to run that business, but they do want the share or the value of the 50% share from their husband or wife that's passed away. So most businesses are not cash, available. They haven't got the money in the account to just find half of a business value. For example, if a business is worth £1 million, they haven't got £500,000 to give to that partner's family straight away. The only option would to either be run the business together or have to sell assets if there's any assets to sell. This kind of policy here, shareholder protection, it gives shareholders and partnerships a way to protect their share for each other. The value of the business can be valued at a certain amount, and they protect themselves for 50% of that value. So hypothetically, as I said, business is worth £1 million. They take out a policy for £500,000 each. One of them was to pass away. The policy can be claimed on. Now, one thing with this policy is there is a clause within it where either party can action that clause. So whether it's the remaining business owner or the family of the shareholder that's passed away, they can actually action the claim request, and it has to go through. So the shares have to be sold to the other person. The policy pays out. The family will receive the £500,000. The business owner has the money in the bank to do that, and then he owns the 100% of the share. I'm just going to hand over to Michael to go over a couple of scenarios where this has actually happened to clients of ours, and we've experienced the downfall of not having one of these policies in place. Michael?
Thank you, Kerri. Yeah, so two scenarios. It's the first one was an estate agency client of ours. They owned the business with his brother. They had a growing lettings portfolio, and sadly, one of the brothers passed away. Now, there wasn't cash in the business to pay out the deceased brother's family. So for many years, and still to this date, this was a good 12, 13 years ago, still to this date, the business continues to pay an income to the deceased's family. So obviously in that situation, they were brothers, they're very close family. But as each family had young children at the time who are now adults, it then causes other issues in terms of who owns the business. Do those children now want to work in the business because they still own the shares? So it's important to sort of have that agreement about what's going to happen in the future, what would happen if, and that's a big question around protection is the what would happen if, what would we want to happen if, and that's what protection helps out. The other scenario was a client with a property portfolio. This was a client who had a property owner of around 12, I think it was about 16 properties, and owned the property portfolio with a friend. So they built the properties portfolio up over many years. Both had their own independent businesses, but when one of the partners died, the family, quite understandably, wanted the cash. Now, the property portfolio was leveraged around 50%, but there's no real cash in the business. So what a client had to do is to sell a lot of the properties, which obviously creates its own tax implications. And along doing so, they had to reduce the size of the portfolio. What would have been a better scenario was if they had some form of life insurance to pay out in the event of one of their deaths, and then the other party could have retained the business the property portfolio as it was, and paid out the deceased's family. So there's a couple of scenarios there, real life scenarios that we've seen within the business where shareholder protection really would have benefited. So
thank you, Michael.
Over to you, Kerri. All right.
Yeah, so yeah, really good to sort of highlight that unfortunately we have experienced clients in this position where we've thought of products that could have, helped, as Michael said there. So there are a couple of examples of some insurance policies for partnerships and for sole traders. So we speak to a lot of landlords. So I'm sure you as accountants have a lot of self-employed, either semi-professional or professional landlords that, similarly to what Michael said, their own property with family or friends. And as we've sort of explained there, it can create issues when one party was to pass away. So we always try and really highlight here that, the two key areas to think about is protecting the assets and also protecting the income. Potentially there is a family there in the background that relies on that income coming in. So, if there's no protection for the asset and the asset does have to be sold, there's no longer any income coming in. So there's two risks to not protecting property for an investment or portfolio landlords. A lot of the time when we have the discussions around buy-to-let property, clients do feel that, they can be sold and the remaining money from the sale can go to the family. But working in the industry for as long as I have and as long as Michael has, and whether you've bought and sold properties yourself, they don't sell overnight. You could be looking up to 9, 10, 12 months to sell, especially with buy-to-let property. You've got other added elements to that of evicting tenants and selling the property. And if it's in a limited company or SPV, there's a lot of extra costs and things involved with selling property. So by having protection for not only the asset, but for the income, you're kind of covering every eventuality, that you don't just have to sell everything as a solution. There's a simple solution there under insurance. All right. So we like to work with accountants because your clients better than they know themselves, and their accounts, their income, their bank statements. So we like to say to the accountants that we work with, there's a really good way that you can help your clients come out of that 60% if they don't have any benefits in place, any protection. And having the advice can just be a massive contribution to their decision making and how they feel about protection, whether they have it already or need to review that or don't have it at all. So the first thing we always suggest is, if you haven't seen any insurance payments from their personal bank accounts, do they have any? Just sort of asking them, I haven't noticed any direct debits coming out for any insurance. A lot of the time you would recognise certain companies that you've heard of, like Legal and General, Vitality, Aviva. They're the kind of policies to look out for. No insurance is coming out of the business bank account. So they may be personally protected from the personal bank account, but are they protecting or have anything for or from the business? So two good sources of, questioning that area. Multiple shareholders with no clear succession planning arrangement. So depending how far within the business timescale they are, whether they're coming to the end of the business operations or in the peak of the business growing, have they thought about the next steps? What happens at the end? What happens with the business succession planning? Thinking about the after and the estate. if we do notice that they have higher levels of personal insurance payments coming out of the personal account, big recommendation to speak to a financial advisor like ourselves to look at products such as Relevant Life. As I mentioned earlier, Relevant Life will do what you need it to do, the same as a personal life insurance policy, but it is potentially, if you qualify in the right areas, it is a tax efficient cost to the business and prevents that money still coming out the personal budget. So that's a good area to look into. Large businesses, large business debts, with no obvious protection in place. There's a policy out there called business loan protection. So, you know, it may not be something that is affordable or that wants to be left if somebody was to pass away, because it's a big expense to the business if there's no protection to clear that loan. And also clients that you see with big property portfolios, as Michael mentioned, you know, a lot of landlords tend to have quite large mortgages leveraged against their portfolios. If there's no clear plan for that and the contingency of that, how do we solve that issue? You know, we're here to give the advice, but if you could send clients over to see the advice, see for themselves that there's potentially a gap within their own personal or business plans, and we can obviously fill that gap hopefully for them. Just coming back onto the succession planning now. So there's long-term protection policies that we can also offer to help with succession planning and the future. There's 3 areas that sort of fall under this umbrella. So for clients that have big estates that haven't got anything in place to protect that in the future, there's a policy known as whole of life. There's not immediate need for that, but it does come with, you know, long-term value. So whole of life plans actually do not have an end date. The end date is the policyholder passing away. And what this does, it protects the inheritance tax bill at the end of their life. And if there is a big bill, then this policy can protect the estate for the family. There's another option here. If you are thinking of temporary transfers. So a lot of clients that I speak to are currently in the process of gifting some of their assets, gifting some properties, passing that over whilst they're still here. But you do have that 7-year tax rule that applies. So during that 7 years, if the person who gifted, you know, 3 houses to their child, for example, those 3 houses are going to come back into an inheritance tax bill liability. Each year, as you will all know, that does reduce down from the 40% down to 0. But there's a way to solve this, and it's called, you might have heard it as a potentially exempt transfer, so a PET policy, or we have a couple of policies called vivos policy. And what the policy does is it reduces alongside the inheritance tax bill over that 7 years. So at any point, if that policyholder was to pass away, any tax liable for that gift, whether it's at year 4, year 3, it's covered by this policy. So it is a stopgap solution if you're in the middle of transferring estates and everything else in between, where you might not need a whole of life policy because you're doing the transfers now, but you've got that 7-year risk of inheritance tax still being due. One other thing we always make sure everybody thinks about or does is any policies they have to write them into what's called a discretionary trust. The benefit of this is the policy does not ever form part of the estate. Okay, so the policyholder writes that policy into trust. They write that policy into trust for husband, wife, children, whoever it may be. And at the point the policy was claimed upon, the beneficiary would receive the money direct. It never forms part of the estate, and it also doesn't need probate being granted to access the policy. So once you've decided on your policy, you know, what works for you, what's right for you, whole of life, whatever it may be, the final cherry and the key element is that discretionary trust. So we always make sure everybody understands what that is, why they need it, and the benefit of having it. And that's what is, you know, part of our advice, making sure that the policy works either way it gets claimed on. There are lots of other policies that I cover, from personal to business, but these are, like I said, the key areas we wanted to highlight today. So if anybody does have any clients that they want to sort of discuss or have any policies that they want to find out more about, then feel free to let me know. I just wanted to go through a couple of claim examples from one of our providers, LV, Liverpool Victoria. You might have heard of them. So these are real life claim stories. These are for clients who have taken policies and needed to claim on them. So I just wanted to highlight to you. So LV had Shelley, who took a policy out with them when she was only young. She passed away sadly at 28 after a short illness, and her husband had quite a large mortgage. They had a mortgage together, which was then left for him to pay. Fortunately, Shelley's life insurance policy was able to clear the mortgage, which meant that her husband could live in the property mortgage free, could reduce his hours at work to take over sole care of their 4-year-old daughter. Now, Shelley was 28 at the time that she passed away. When she took the policy, she was healthy, non-smoker, and no other health declarations. For £475,000 of life cover, the policy cost Shelley £21 a month. So one thing that we do find is a lot of clients that I speak to are quite surprised how cheap some policies can be, especially for the amount of cover they could receive. So this was just an example of how life insurance can clear a mortgage or help in another way. They recently had a critical illness claim by a lady named Susan. So as I mentioned before at the beginning, 1 in 2 of us statistically would potentially be diagnosed with cancer in our lifetime. Susan was diagnosed with stage 3 breast cancer. And after providing medical evidence from her consultant, her oncologist, her claim was paid, and the lump sum of £120,000 was paid within sort of 3 days of her claim. This enabled Susan to, you know, not worry financially while she was going through cancer treatment, going through surgery, aftercare, recovery. You know, it takes a long time, and the last thing anybody wants to do is worry about getting better or having to go back to work too quickly for financial reasons. So critical illness can obviously prevent you worrying financially, can provide a lump sum to help in this kind of scenario. Again, critical illness can come in reasonably priced. It does all come under factors such as your age, smoker status, health, to what the premiums can be. And one that I really wanted to highlight for self-employed clients is income protection. So a lot of self-employed clients that I speak to are manual workers, or, you know, they do need to physically be able to work to earn their income. So one of LV's income protection claims a couple of years back was for a self-employed graphic designer, and he fractured his dormant hand and couldn't work. You know, being a graphic designer, his hands are his most important tool. So again, had to obviously supply evidence of his injury, also needed to supply latest tax returns and income figures from his accountant, and the cover was able to pay him out £2,300 a month, which was worked out to be around 65% of his gross income. And that was made up from his salary, his dividends. You can also insure your P11D benefits, spouse's salary, lots of other things if you're a sole trader that you can include. But it just goes to show the importance of this kind of policy for a self-employed applicant. Whilst injured, he cannot earn any money, and this income protection not only prevented him from missing his mortgage payments, his own bills, carried on helping him pay some business expenses, business costs that he had as well. Again, a policy like this can start from anywhere from, you know, £25 to £30, depending on age, smoker status, health. And one thing that I just want to leave you with is, when I speak to clients, you know, it's not about having everything. For me, insurance is about ensuring you have not unnecessary policies, but making sure your mortgage could be cleared if you pass away, you'd be financially supported in the event of serious illness, that any income you have, whether it's just your income or household income, could be continued if you can't work. And one thing as well is checking your current insurance, you know, making sure it's still suitable for your needs and that you're not overpaying for it, because there are times where potentially clients are overpaying for something, and we could potentially find cheaper or better policies out there. So that's all from me. Happy to take any questions in a moment. Happy to have any direct conversations, or if you have any clients that you want me to speak to, then feel free to share them, our details, or pass them over. So I'm going to hand back over to Michael just to finish up about home of mortgages and home of insurance. And thank you for joining today. You're on mute, Michael, sorry.
Thank you. I think I've learnt by now. Thanks, Kerri. That was absolutely excellent. I think it just highlights the importance of protection. That, you know, the more you're aware of it, the more you see the, say, opportunity, but the risk to clients, and being able to sort of just signpost is very important, and that's all we're sort of asking is that signposting. So here is. You can register to become an introducer of ours. There's a QR code there. As we discussed last week in the mortgage session, whether it's mortgages you're referring, residential, buy-to-let, whether it's for protection, whether it's commercial cases, wherever your clients need that advice, then you please register as an introducer. You'll receive our regular emails, our webinars, invites to our webinars, and just giving you a bit more information around what's going on in the market, help your clients. Reasons why accountants sign up with us is because we do have experts in complex cases, whether it's been protection, specialists in protection, specialists in specialist finance, and the residential side. We query to keys, we own it. What that means is we don't just stop giving the advice and submission. We have a full admin team here that help the client all the way through to completion. Clients do get advice on the same day, and we can pay a commission if you require a commission out to our accountants as well for referrals. Just a reminder again, so the next webinar will be the 18th of June, commercial and specialist finance. The QR code's there, but you'll also receive an invite for joining us today. So if you don't know anything about home mortgages, we are a team of 19 mortgage and insurance advisors and the admin team as well. We service approximately 30 accountants and advice firms. And something we're very, very proud of is we now, and this was only 1650 last time I saw this stat, so 1,723 5-star FIFO reviews. So we just customer service is really important to us. So you're in a good place when you refer your clients over to us. So thank you very much for attending today. I'll stop sharing my screen now. And if there aren't any questions, I can't see any questions in the chat. Is there anything else you'd like to add, Kerri? Oh, hold on a sec. Somebody's got their hand up. Paulkit, have you got a question? If you just like to pop it in the chat.
Yeah, while Paulkit's typing, I'm just gonna add. No, you know, the main thing is if you feel that client just needs some advice, whether you know if they've got a need or not, just refer them over. I think knowledge is power, you know, and having that knowledge, whether they do anything with it, you know, is one thing, but just having the knowledge to understand what's available, where the gaps are in their own personal or business circumstances, and how they can fill those gaps. I think that's the important thing. And obviously, whether they decide to take protection is personal choice, but as long as you know why you need it and how you can access it and the right advice, I think it does help with deciding whether it's right for them or not.
Great.
So I can find out, Paulkit, about this. So shareholder protection, can this be taken if one of the shareholders is UK resident and citizen and the other is a UK citizen but not a UK resident? So generally with insurance, you do need to be a UK resident to apply. Even if you move after applying, there are certain countries where you would no longer actually be covered for. So I would need to know specifically a little bit more about that client in particular. There's usually a rule around them needing to be in the UK for about 162 days a year to be able to apply for cover in the UK. So potentially, depending on the circumstances for this particular client, that there might be the option to apply for cover. But we would need to know a little bit more about that one. So feel free to email me or call me. We can discuss them in more detail.
Okay, is there any other questions at all?
I think Paul can. Yeah, okay, yeah. So they generally do need to be in the country for at least 50% of the year, have a UK address, have a UK bank account to pay that direct debit from. So potentially if they don't meet those needs. But yeah, feel free to give us a call. I'll pop my email here for you as well. And we'll catch up. Thank you.
That's excellent. Okay, so yeah, Kerri's email is Kerri, KERRI at homeofinsurance.co.uk, and she's just popped it in the chat there. So feel free to call or email her with any further questions you've got. So thanks a lot for attending today. We really appreciate your time, and we look forward to seeing you at the next webinar. Thank you.
Thank you. Bye-bye.